Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about the Bank of Canada and will the Bank of Canada stop increasing interest rates? Stay tuned, you don't want to miss it. The Bank of Canada has delivered a 50 basis point increase right before the holiday season, and this could obviously spell disaster for many Canadians who are on adjustable rate mortgages or those static mortgages with trigger rates. Now, I want to cover a little bit more about how this is going to impact those Canadians, as it has been an ongoing issue and something we've covered extensively on the channel. But also I want to talk a little bit more of how we got to this point. And in between that, we're going to be talking about some of the things that are happening around the central bank and how we can basically look to the future and see, will the Bank of Canada actually continue to increase its policy rate, or are we at the end of the rate hiking cycle? And I'll leave that for our viewers to decide and to put some comments below about what you think will happen in 2023. But first and foremost, obviously for Canadians who have a mortgage with a trigger rate. Now, if you have not yet been contacted by your lender, we encourage you to reach out to them. Those are the mortgage payments that have not moved. Your payment has remained the same. You will find yourself in a position where that entire payment that you were making will go towards covering just the interest portion of that mortgage. And it's important to note a lot of these clients are the ones that initiated mortgages generally between March of 2020 and March of 2022 up into July. So obviously, depending on when that mortgage was originated, you might have already breached that trigger rate. And what you will notice, or what you will be advised, is that you can increase your payment in order to put some more money to cover that interest portion, or increase it enough that you're actually back on track with those principal amounts, or you're able to lock into a fixed rate component, whatever the bank will be offering, whether it be a 1 to 5 year, or alternatively, if you have the capacity to put some additional funds towards your balance, a lump sum prepayment. Now, the other option that has come to light over the last little while is that banks are allowing clients that are finding themselves in a challenging situation to actually reverse amortize that mortgage. And if they're not able to increase their payments, they're allowed to increase their principal amount by the interest that is due. So basically tacking on that interest to their principal, kicking the can down the road, which could be creating multiple issues for lenders and consumers alike in the future. Now, obviously, I want to point out that this is not something that is good necessarily, but it can be relief for clients that find themselves in a situation right now that they can't make ends meet due to obviously a catastrophic life-changing situation. But it's important to know it's not just for insured mortgages, it's also for conventional mortgages as well. And previously, the insurance companies, the insurance default providers such as Sagan, Canada Guarantee, CMHC, Canadian Mortgage and Housing Corporation, have posted bulletins to lenders that allow them to increase their amortizations if the clients cannot service the mortgage under the servicing ratios that were originated at the time the mortgage was officiated. So obviously it's important to look at some of these things, and I don't necessarily believe that this is a positive thing for clients down the road, because it may continue to hand tie them to that lender if they're not able to refinance or restructure out of the mortgage. Obviously, with home prices coming down significantly from their highs in early 2022. So this could pose a major problem. One thing that we do notice, and one thing that we will keep a close eye on in this channel, so make sure to like, share, and subscribe, is that we're going to be paying attention to the default rates, those 90-day arrears, what is happening with those, and as the lenders start to publish some of their data, as they've just finalized their year end. And basically, if you look at some of the lenders, the major top 6 banks, obviously a lot of them have posted some losses. And this may come as no surprise, as a lot of their funding or a lot of their budget is now being increased. They're increasing what is called their provisions for bad loans, or their stop loss provisions for these particular products. In the past few years, we've seen those reserves actually be very, very low because the banks believe default was it was less risky than it is now with obviously elevated interest rates. So this could be something to pay attention to in the coming months as we see the banks continue to provide funding, or how is the liquidity going to be? Is there going to be a credit crisis? Is that going to push us down the road where the central banks will have to do something much like they did in 2020 to ensure that there is liquidity in the system? Obviously, that is something that we will discuss further as we get more and more information. But interesting enough, a lot of these banks are looking internally to their actual balance sheets, their clients, those mortgages. And one recent article by Scotiabank And it's important to note that Scotiabank is one of those lenders that actually has an adjustable rate mortgage. Those are the ones that when the policy rate increases and prime rate increases, your payments will adjust accordingly. And just as a side note for those Canadians who have maybe a mortgage with National Bank, Scotiabank, even HSBC, and a lot of the broker-friendly banks, you will have noticed these payments changing over the last 7 rate hikes. So what does that mean? Obviously, over the last 7 hikes, we have seen an average of about $240 increase to each $100,000 mortgage. So for every $100,000, you would have seen a potential $240 increase. Let's say you have a $500,000 mortgage, well, that's about $1,200 you would have seen your payment go up. But what's interesting to note is that lenders like Scotiabank, National Bank would have probably seen a lot of uptick in their defaults. And although we don't have much data, these lenders, because of the fact that those payments have manually gone up automatically with very little decision from the client, they would have just got a notice, hey, your payment's changing, as opposed to these sugar rate mortgages, we would have potentially seen a much more significant uptick with these types of lenders. And we have yet to get that data. That's not that we're saying that it hasn't happened or it's not happening. It could be happening behind the scenes, but yet we haven't seen anything dictated to us yet, and we'll keep a close eye on that as well. And obviously, as I said earlier, home prices, default rates are going to be a major catalyst for what will happen with the housing market. Are we going to see fire sales in the next little while? Are Canadians holding steady and basically have equity, have the ability to keep their mortgages in check, and are waiting to sell these homes, as obviously there is a big standoff between buyers and sellers, inventory still remaining relatively low even in this market. So obviously there's a lot of conversations around that, and something that we're going to be paying close attention to, especially for a lot of buyers that might be looking to get out into the market in the new year. Now, obviously timing the market is very complicated. What do you think is going to happen in 2023 with the housing market? Are we going to see a floor with immigration? Is it going to be an issue as interest rates continue to rise? And that's something that I want to get into. Central Bank of Canada has been under the gun or in the crosshairs in the media lately, obviously, because of the fact that they've not only lost $522 million, now we're looking at figuring out who's going to be paying this tab, who's going to pick up the bill. Are they going to defer? Are they going to basically pass on this to the actual taxpayers like you and I? And one interesting side note is obviously in the past, and although I believe central banks and governments should be completely detached, you know, you have a central bank that is basically, if there's a profit, they kick it back to the government. And that is obviously questionable if you look at their alignment. So if we also look at the Bank of Canada and, you know, Governor Tiff Macklem, obviously they've missed the mark, something we've talked about extensively, from inflation being transitory to keeping interest rates low for an extended period of time. I believe that the Bank of Canada should have been increasing policy rate back in the summer of 2021 as soon as we started to see that inflationary number rise. And although we are at 6.9% down from 8.1, we still have a 4-decade high of inflation, and obviously interest rate and policy rate at now 4.25%, the highest it's been since 2008, since the great financial crisis, obviously points to different outcomes. And will the Bank of Canada induce a recession? Are we in a recession? And obviously it depends, are we in a technical recession, a physical recession? Obviously there's a lot of controversy around this conversation. It depends on how you define a recession, and also looking at, you know, employment, because employment is, or unemployment is still relatively high, right? We don't have a lot of the jobs leaving the market. And this is a major problem for the central bank, because that was something else that they were under the gun for with some of the labor unions, because they want to promote basically unemployment to rise in order to bring inflation back down. Now, obviously, this is contradictory. You do want Canadians working. A lot of Canadians will rather for that matter, be working and maybe pay a little bit more than to lose their job and not be able to afford. Obviously, a lot of conversation around that, but it is interesting to point out that is what they are talking about. And obviously the wage spiral, as companies with higher interest rates will find it harder to invest in their businesses, and obviously with Canadians finding it more challenging to make those monthly obligations. Household spending has come down, I believe, about 0.3%. And that is an important indicator, because we're starting to see some of the monetary policy in the past starting to bite. And one important thing that I look at with the central bank and what their sentiment is, right? So if you look at Jerome Powell from the US Federal Reserve and you look at the Central Bank of Canada, their tones are very much on point. and they have changed directions. And by that I mean, if you watch these interviews and you listen to what they have to say, they went from a very hawkish, very aggressive, like we're going to be increasing rates till the cows come home type of mentality, to now saying, hey, the end is near. I think we need to moderate our changes because we don't yet know or feel the impacts yet, as it can take 6 to 8 quarters to feel the changes that the Bank of Canada has done. You have to keep in mind, out of the 8 meetings that happened in 2022, 7 of those meetings, they've increased policy rate. So, there are many things to consider. I personally believe, however, that the Bank of Canada is at the end of its rate hiking cycle. Yet I believe the Bank of Canada went 50 basis points. Basically, they ripped off the Band-Aid. They said, here it is. Here is our terminal rate of 4.25%. I believe that's where they're going to end it. There are controversies, or conversations, I should say, where maybe on January 25th, that will be the next time the Bank of Canada meets in the new year. There might be another 0.25% in there, but I think we're pretty much on the same path. I think there's going to be a very maybe extended period of no increases. And then potentially down the road, we will see the policy rates maybe revert back, not to where the pandemic levels were back in 2020, 2021. We're not going to see that. I hope not, because that would potentially reignite the major problem that put us here in the first place when it comes to the housing market. But I do think we're going to see a retraction in interest rates in the coming year, maybe by the third quarter of 2023. Because obviously, in order to come out of recession, in order to re-stimulate the economy, the central banks have the only lever is to play around with interest rates. And if we want to basically bring the economy back up and start to turn it back on, they will need to do something with interest rates in the future. So leave those comments below. We do read the comments, and I want to hear what you have to say. And if you know that someone that might find this content informative or educational, please feel free to share that. And while you share that video, don't forget to hit the like, share, and subscribe button so that we can get this content out to as many Canadians as possible. And we'll leave the video here, hoping that everyone has a great Friday and an even better weekend ahead. Until next week, thanks again for watching. Thanks for clicking.